My name is Tim Craighead. I'm the one of the directors of research at Bloomberg Intelligence, the investment research business at Bloomberg. And it's my pleasure to welcome you all to another edition of TrendWatch, this being the 20th edition of this webinar series, where we try to focus attention on key topics, key trends, as the title suggests, that are important in the marketplace, and have a conversation with some notable investors, CIOs, asset allocators on the topic at hand. And certainly that is the case today. Let me go through a couple of points of housekeeping before I bring in our three panelists. Point number one, the webinar will be somewhere about 40 minutes or so in length. There's a series of things that we have planned to discuss, but if there are questions or ideas or topics that you have, please feel free to drop a question into the chat for the Zoom. And we'll see the questions and fold those in as and when. That's point number one. Point number two, I'd like to give just a little bit of background on Evenco, as well as BI, since I've got the mic here and want to give you a smidge of perspective. First thing with Evenco, you may be aware, but maybe you're not, beyond the TrendWatch webinar that you're listening here, Evenco also puts on a whole suite of fund forums. There's actually one going on today in Madrid with a host of funds that are presenting and having dialogue and discussion with asset allocators, CIOs, etc. There in the Spanish and Portuguese market. There are a host of these that are coming up in the autumn. You can see the lineup here. You can see it on Evenco's webpage. And I also mentioned that their quarterly newsletter is coming out tomorrow, which you'll find, I think, on LinkedIn, and you can certainly, connect with your friends at Evenco and get access. From a BI perspective, just to give a little background on what is Bloomberg Intelligence, we're a team of almost 500 professionals, traditional investment research in many ways within the context of covering markets, industries, companies, equity and credit, currencies and commodities, lots of interesting integrated work such as ESG and policy analysis as well, and it's all on the terminal. So if we can tell you more about BI, please let us know. You've got a terminal, you have us, and we'd love to talk more about it. Without further ado, let me get into the heart of what we're here for, and that is to have a conversation with these three thoughtful and experienced investors. Patrick, Tapan, and Alexis, let me turn the mic over to you all and let you introduce yourself. Patrick, you're front left in my screen, so I'll give you the mic first.
Thanks a lot. Hello, everyone. My name is Patrick Stanner. I'm at Swiss Re, which is a globally active reinsurance company. I'm heading macro strategy, and in that role, I'm responsible for the economic and interest rate forecasts for the group's roughly $100 billion asset portfolio. I'm also responsible for the alternative scenarios that are used in regulatory stress tests and so on.
Very good. Thank you. Alexis, hand it over to you.
Yeah, thank you. Thank you, Tim. Thank you, Evenco also. I'm very happy to be here. So my name is Alexis Bienvenu. I'm working in Paris for La Financière de l'Échiquier, which is a complicated name in English, so we can say LFDE, it's simpler. We belong to the LBPAM group, which is the asset management part of La Banque Postale in France. And I work in the asset allocation team as a senior portfolio manager.
Very good. And Tapan.
Thanks, Alexis. So I'm Tapan Datta. I'm representing Global Asset Allocation at Aon as the dedicated team, just helping clients reach their kind of ultimate investment destinations, pension funds, other institutional investors, endowments, foundations, you name it. And we also help our clients navigate through some difficult and challenging market conditions, of which there have been plenty in the last few years, haven't there?
That is very true. So thank you for the introductions. Let's crack on. I think it's important before we get into actual positioning for the second half of 24 and thinking about into 25, that we get a little bit of the lay of the land from a macro point of view. What are you thinking? What are your shops thinking on a couple of different particularly pertinent issues? The first one to start with is that sort of background of economic inflation, interest rates. Where are we? There are a lot of indicators right now that are suggesting a little bit of a slowdown. Not very many people are calling for an outright recession in one region or another. But I'm curious what you all think. And you know, within that context, part of it's economics, but a lot of it harkens back, and I'll show one slide here real quick, to the inflation outlook and how does economic growth and what's transpiring with where we're at post-pandemic play into inflation. I could show a screen like this for the US. I've shown here Europe. I could show other regions, but pretty much all of them are showing the same thing. Pre-pandemic low inflation, the surge that we all knew, rolling off the backside of that, but notably 2024 isn't where we were pre-pandemic. Our point of view happens to be that we're not going to go back for several reasons, but I'm curious, economic inflation, where do you all stand? And Patrick, you're the economist among us, so maybe we'll start off with you, but Alexis, Tapan, please also jump in.
Sure, happy to. Thanks. So with regards to where we stand, I think we are witnessing a large part of the normalization cycle. Inflation has eased, as you just showed as well, though particularly elevated core inflation in the services sector is still the main challenge in a lot of the Western economies. Some slowing is visible in the US through various labor market measures, but also other economic indicators. And the key question is obviously whether that can continue smoothly or whether we see some cracks appearing, which would obviously matter a great deal for the capital market environment and outlook going forward. We actually share what you just mentioned in terms of longer term inflation outlook. We do believe that we are going to see a somewhat higher inflation environment going forward, not to the extent that we saw now the last couple of years, but you know, maybe 50 basis points to 100 basis points higher than what we were used to pre-COVID. And so, you know, an environment of 2.5% to 3% might just be the new normal going forward. And that has also quite a bit of implications with regards to longer term asset allocation strategies as you're trying to protect the purchasing power going forward. But I'm sure we'll get to that at a later point.
Indeed. Tapan or Alexis, thoughts?
Let me just jump in. I think the basic problem here, I mean, there is a fundamental problem, which is that I think the ghosts of the COVID pandemic are still with us. So it's really hard to time the cycle because obviously the COVID cycle, if you like, that mini cycle of a downturn and then a rebound has really confused the whole sort of business cycle timing thing. But of course, it unleashed some big changes. So I think a lot of it just depends on, I think Patrick touched on it, just how transitory you think the inflation surge post-COVID has been. If it's transitory, then you kind of believe in immaculate disinflation, go all the way down to target, soft landing, all of those things. If you are one of those people like me who don't believe that it's quite as simple as that, then I think we're in the kind of shadow lands between kind of no landing and a soft landing, and it's just not clear. We'll just have to give it a couple of years to find out. My sense is that we're closer to the no landing scenarios, and that inflation will persist at relatively high levels. But that's just me.
No, fair enough. And Alexis, any thoughts?
Yeah, I agree with the general picture of Patrick and Tapan. Perhaps one thing about inflation, it's likely that inflation will stay a bit higher than it was before COVID. And I think it's a very good thing, by the way, because for a number of years, central bankers, the also the IMF and other institutions have called openly or not for a higher neutral rate, for a higher central bank rate, because mostly there was a lack of inflation pre-COVID, mostly in Europe. And they were calling for a higher inflation that would help also to reimburse and for the debt burden that is behind that is in front of us. So for the next couple of years, inflation could be a higher inflation, a bit higher inflation could be encouraged openly or not by central bankers, and we should follow this path.
Yeah. Very good. So if that's the view, and I think we're kind of all within the same general ballpark, sorry for the Americanism there, but it then begs or rolls into the next question, and that is, what about interest rates? Obviously, we've had the bulge that we've had. There's all sorts of debates about pivots. Now that's starting to be a pivot in the US versus Europe versus the UK versus the opposite of what's going on from the standpoint of Japan. I'll show another quick little picture. Another Bloomberg piece of functionality, MIPR. If you haven't used it, you should. It's a pretty interesting finger on the pulse of what's going on from the standpoint of policy expectations. The green line here it shows the current market expectation for policy rates in the US. Again, we could switch regions and show similar sorts of pivots that are now implied. The yellow is where we were back at the beginning of the year, when there was lots of expectations about a sharp pivot, and sooner rather than later, and a lot. Curious what you all think from the standpoint of when the pivots happen. Are they bigger than what's currently now implied or less? And do you think there's a major divergence between different regions that maybe have implications or read across into the world of, say, currencies? Any thoughts here? Alexis, do you want to jump in on this one?
Yeah, sure. It's very nice to have this projection of the rate policy, because at the beginning of the year, it was obvious that the enthusiasm about the rate cuts was very high, probably too high. And now we could be on the other side, perhaps too pessimistic on the rate cuts. So that may give very good surprises in the next quarters. So it's a very sweet spot to be at the moment. We follow the idea that the rate cuts will happen, and perhaps a bit more aggressively than what is priced in the market, because we have doubts. We can talk about it later, but we have some doubts about the sustainability of the job market in the US. We see many weakness signs in this market. So if we had to stake some bet against the market, that would be on the downside for the rates. And that would be, of course, supportive for the markets. So what could be a bit annoying, a weakness in the job market could also be a good positive surprise for the market. So it's a sweet spot for us.
Oh, very interesting. Tapan or Patrick?
Shall I go first, Patrick?
Sure.
So I think I think the idea of divergence is frankly overstated, because everybody's kind of around the same place, maybe 6 months away from each other. But I think more interesting would be if Michelle Bowman was right, and the US eventually, because of inflation persistence, was raising rates. Now that would be real divergence if they raise, and the ECB and the UK and so on, Bank of England cut rates. So I don't think the divergence story has much weight at this point. The key issue is not so much just exactly the exact time, of when rates fall, but really where the landing place is, and that's where obviously the big debates are. And the question is, and that of course goes back to the question you raised earlier about persistence of inflation and where rates land, and just given the backdrop of where the labor market is. Some signs of weakness clearly in the US, but it's tough, really, given the inflation story and the structurally tighter labor markets we've seen since post-COVID, to cut rates all the way down. And many of the factors that drive the level of long-term rates suggest that rates are going to settle at higher levels than pre-COVID. That's the way I would see it, certainly.
I totally agree with what Tapan and also Alexis mentioned. I think it's less about the timing of rate cuts than the end point, which is basically the trough of the next hiking cycle, if you like. What I do find surprising, though, is that we went through a global tightening cycle, and to a large extent, not universally, but if you look at the ECB, the Fed, the Bank of England, then they are basically pricing in a universal easing cycle. So the expected rate cuts that are priced for the BOE, the Fed, and the ECB until the end of 2025 is a cumulative 125 to 150 basis points. So the difference is only 25 basis points in cumulative cuts across these three central banks, when the economic backdrop is actually pretty different. And so it's in a way surprising that you have so little divergence priced in when actually the underlying fundamentals look a bit different. And I think it wouldn't be surprising to see a bit more divergence there in terms of what's actually being priced. I think we also need to remember that it's not only a question of the economic environment, but also the refinancing schedules of corporates, because that's ultimately how monetary policy is transmitted into the real economy. And in Europe, actually, particularly in the high yield space, the maturity walls are much, much larger as relative to the size of the market over the next couple of years compared to the US. And so that should also provide a bit more pressure on the euro area, and also or could result in some more divergence from a central bank pricing point of view.
That's very interesting. A good point. I do want to make sure we get into the asset allocation thing, but there are a couple of other elements I want to hit on before. One is to get a quick answer, if any of you all want to jump in on a question that somebody had popped into the system. This is from Vasco, who had drawn the analogy of the late 90s when we were having the dot-com boom and the productivity that fed through. And arguably, if you look today, AI has, in many ways, more of a potential profound impact from the standpoint of productivity, some would say anyway. Is that an opportunity to put downward pressure on inflation that can then feed through into a brighter interest rate period, or is that too optimistic at this point? Any thoughts?
I would say, I just would say that the consequences of the artificial intelligence on the market, on the companies, is not very sensitive now. We don't feel it really hard in the numbers. We can feel it or of course in the tech sector, but for the industry, for the services in general, AI hasn't proved very strong for the moment as a source of profitability. So I'm not sure that it will be that it will be a strong factor for disinflation in the next couple of years. And if you take the history as a guide with internet, it took many years before you could see the profitability numbers deriving from the internet in the whole companies. Of course, for the internet companies, it was obvious. But for the rest of the companies, it took years and years, and it has been like a mystery for a decade. And it could happen the same with the AI. We'll see. But I would be a bit cautious on this.
Oh, fair enough. Well, we can come back to this because we are going to talk a little bit more about AI from a thematic perspective. We are doing a ton of work on a bottom-up industry basis, not just the AI itself, but like I'm sure all of you all and the listeners as well, industry by industry, what are the potential benefits? When will they come? Who will be the potential winners or losers? More to come on that front. Another topic for a trend watch. Last thing from a top-down perspective that I wanted to hit on just briefly. You can't have much of a discussion these days if you don't talk about politics or specifically elections. I've shown elements of this slide in various presentations over the course of this year, and it still rings true. It is an unprecedented year for effectively presidential elections or prime minister elections, etc. Some of them we knew were going to be controversial, like Trump versus Biden. And by the way, if you weren't aware, the first debate is this evening if you want to stay up really late and keep yourself awake. And obviously next week we have the UK election. The thing that was unexpected at this point now is the French election, stating the obvious. For you all as panelists, with all of this, I think quite often it's easy to say, well, elections make great news stories, but they're not really that big of a deal from an investment perspective. Arguably, some of these may be because of policy differences that can occur with things like energy transition stimulus or infrastructure programs or right-wing versus left-wing or trade policy and what happens with relationships with China, etc. What are you most focused on in these elections? What are you excited about, or what are you most worried about? Who wants to go first?
And I'm happy to cover a couple of points. I think all of the elections are important. Needless to say, markets were too complacent around it, and I think the repricing of political risk recently is at the very least healthy. But I think what's also important to remember is just because the elections ultimately pass doesn't mean the political risk disappears, because I think we need to think through the factors that have caused the political tensions that we are seeing, including, income inequality, wealth inequality, social security, defense spending, these types of topics. And that's, these are all medium to longer term topics, and they're not going to disappear. And so I think the political tensions and potential spillovers you might see into economies and markets is just something that we need to get a little bit more used to, because a lot of the peace dividends that we have enjoyed over the past, say, 40 years or so, it appears to be changing. It doesn't change typically, very quickly, but we've gone through a lot of the political tensions now over the past 10 years or so, and so I think this is encompassing and describing simply a bit of a new reality that we need to face.
No, fair enough. Other thoughts?
Yeah, Tapan, if you want.
Oh, sure. So no, my 2 pennies worth on this is just that elections, geopolitics, they don't matter until they do. So, and as we know, so there's this kind of massive, kind of fairly violent reaction to things, especially things that have been obviously clearly unexpected. So as we know with Liz Truss and the French elections, there is ultimately some sort of violent reaction. And we'll have to see. I guess the Biden-Trump rematch is the big story of the day in terms of what impact that could have on markets. And there are 2 ways of looking at it. One is if you're worried about the fiscal position, which is potentially heading into some sort of looming crisis, given the degree of overspending that the US is doing and the debt trajectories and so on, it feels to me as though there isn't that much of a difference between the two. So I'm not sure that makes a huge difference. Arguably, a Trump presidency would be, because of the cuts in taxes, would potentially be more risky for the fiscal position. But it's more the unpredictability aspect of a Trump presidency that is potentially more concerning. So yes, so all those elections and particularly the US election it is going to be market impacting, but just you don't know quite when it's going to hit and why and exactly where. But it clearly does make a big difference in terms of market outcomes.
Yeah, I agree with what has been said, and I would just perhaps add one or 2 points. The first one is that it's true that we don't know what happened with the US election, but in most cases, it could be just a matter of sector allocation. Because if you see the Trump mandate in the past, when in the first mandate, markets went up until the COVID, and they were very happy with the Trump administration. And with the Biden administration, it's been the same. Well, inflation has been, of course, a problem. But after 1 year into 2022, it went back. Disinflation came in force, and the market went up. So there is no huge differences, perhaps, for the market as a whole. But of course, for sector allocation, for renewable, for example, or for defense, or for some thematics, there could be a huge difference between Trump and Biden. But it's more a kind of a fine tuning than a general point of view. Perhaps I would add one point about the French election, because I'm the French here. So of course I'm biased, and I won't tell anything embarrassing, but there could be a long-term effect of our election. Of course, there is a short-term effect, the fear, the uncertainty, etc., and we will come over in a couple of weeks that will be stabilized. But on the longer term, for the next years, it could play a role for the European project. Because if we have a government that is less cooperative with the European Union, then many projects that have been drafted in the last years could be stopped, or could be at least embarrassed. And for example, the banking union, or the fiscal union, or the budgetary union in Europe, all of them were topics that were a bit advanced and largely discussed, and that could be stopped by the election of an anti-European government here, and that would be a weakness for the European Union. So on the long term, the outcome of the French election will wane, but it will stay a question for, or at least a topic for, the longer term dynamic of the European Union, and then of the European market.
Oh, very good. And I appreciate all of you all's perspective. And Alexis, I'm glad you brought that issue up. It seems to me that when the snap election in France first came up, and you had the immediate sort of uncertainty hit of things, there were lots of comparisons. Oh, is this similar to what could have happened or what did happen with Italy? And the answer from our perspective was absolutely not. In some ways, you know, the economic positioning of the two countries is very different, but the importance of France is arguably much more important because of the European project and its influence and being a driver of that. I would also just make one last thing. One last comment. I had mentioned earlier that there's a current Evenco fund forum going on at in Madrid today, and there was a polling question of the people that were there. Who do you think is going to win the U.S. election? And I don't know. Can you see this okay in terms of what the answers are?
Yeah, Trump is a large winner. Yeah, Taylor Swift. Okay, Taylor Swift.
I was going to say, look who was the write-in candidate. At any rate, okay, that's enough silliness. But let's get on with the markets. There was a question about what are the sort of potential allocation or asset class ramifications of the election, and specifically there, I would hearken back to what you all had talked about. Maybe it's not so much asset allocation per se, but more sectoral implications. And we've had a good bit of work that we just published in a deep dive report here within BI on the Inflation Reduction Act and how that plays through into the whole sort of energy transition element. I think that's an important consideration we'll come back to. But think about a different sort of picture, and I'm curious if we use this as a launch pad for equity versus fixed income in the current marketplace. Now, this is looking at the 10-year yield in Europe versus the earnings yield of the stock 600. And obviously there's a long-standing relationship, but there's clearly a divergence right now. And equity risk premiums have compressed accordingly. If you were to look at this from a US perspective, the divergence is clearly even more marked. What are you thinking about equities versus fixed income now that there is clearly an alternative from the standpoint of yield on fixed income that wasn't there pre-pandemic? Who wants to go forward? Who wants to go first on this one?
Shall I just dive in?
Oh, sure, please.
And so look, there's this on a relative basis, of course, equities look pretty trashy given what's happened to the equity risk premium. However you measure it, the relative attractions of equities has clearly waned. Arguably, absolute valuations are quite high too. So the relatives are problematic, but that doesn't mean it's still, the green lights are flashing for bonds, because as we know, bonds have been through a bit of a ringer, and of late there's a little bit of more stabilization of, yields have stopped going up at quite the rate they were going up. So it is a little bit better for bonds, but it's hard to argue that equities or bonds are particularly attractive right now. So the focus has to be on sort of on other asset classes, which are either illiquid or difficult to access, complex. All of those things come into play, but it's on a kind of overall basis, yes, a little bit more positive vis-a-vis bonds. And the other problem I would mention is just the fact that overall portfolio, the kind of quality of the ride you're getting with a standard kind of 60-40 or a balanced portfolio is still pretty rough, because the equity bond correlations are not quite behaving as they should, because obviously correlations still remain kind of by and large pretty positive, and longer term, of course, they've been negative, a small negative. And so that presents some portfolio challenges as well in terms of how to make your ride a little bit smoother while getting the best return you can.
No, fair enough. Well, we'll certainly talk a little bit about the alternatives and liquids, but Alexis or Patrick, do you want to jump in here?
Sure, yeah. I would agree that bonds are very attractive at the moment, and we would argue that for a couple of years, perhaps there could be a kind of a bond golden age, like never before, or like it has been the case before, but a long time ago, because you will not only have a capital appreciation, probably with the rate cuts, but you also will have a large carry, which did not happen for the last 10 years at least. So we have increased our duration in the portfolio progressively. Now we are a bit more than neutral, very enthusiastic about the short maturities and relatively enthusiastic about the longer term. And we think that it will change the way a portfolio can be managed for a couple of years, because the decorrelation could come back. So the negative correlation, which we don't see at the moment, could come back, should come back, and should help to build more resilient portfolios. So bonds duration are fine, even though the spreads are not that high. So they are very much compressed at the moment, but not at the extreme level. So if you compound the duration and the spreads, at the end you get a fair carry that you can rely on for the next couple of quarters or years. So we are relatively optimistic. And the second thing would be that we all agree that inflation should go down, and rates also. So the risk premium of the equities could could come back just as the rates go down. So it's a very comfortable situation.
Oh, very good.
Yeah.
A bull outright. Patrick, how about yourself?
So, I mean, we are primarily an asset liability management investor. And so, like any other insurance company, we are extremely fixed income heavy. And so our our mandate is mostly in rates and investment grade rather than, less, more adventurous parts of the credit curve. But I agree with a lot of what has been said. I think the issue for rates is a bit where on the curve you are really investing, because if you take, for example, a 10-year US Treasury with the inverted yield curve, then if we just have an environment that continues to chug along, you are giving up a lot of carry. The negative carry is pretty significant, and I think there are other parts in the curve that are more attractive than, say, the 10-year. But this aside, I think what Alexis also mentioned, with particularly if you have a growth slowdown, then obviously that would make the picture of rates and government bonds a lot more compelling versus equities. But if we continue to have, pretty reasonable growth and inflation that is running between 2 and 3%, one could also argue that that's not the end of the world for the equity market, because it's a nominal world. Sales are nominal, and so on. So I wouldn't discount that scenario either.
No, very good. And I would say that from the sort of 12, 18 month outlook, yeah, our view tends to be, I think, relatively sanguine. We see earnings growth starting to inflect positive after several quarters of negative earnings trends from a European perspective, and the US continues to chug along, pretty strong. Margins continue to be pretty high, pretty robust. And that's not a bad backdrop. Our concern has been more from a valuation perspective, that there's not an awful lot left to go. Clearly, as you all have pointed out, if interest rates do pull back, that relieves some of that pressure, potentially, all else being equal. The question is how much of that is already discounted in equities given where they're trading, but that's a separate topic. Given that backdrop, I'll give you a choice. You can either pick a fixed income answer, or you can pick an equity answer. What are your thoughts on positioning within the asset class? You all talked a little bit about this. Patrick, you touched on it. Alexis, you touched on it within the world of fixed income. Give maybe more specifics, or choose equities from a regional or sectoral perspective. Where do you think it looks interesting, or where are you concerned? So pick one and dive in one level down. So Patrick, do you want to continue talking?
Yeah, I mean, there are just a couple of considerations, and again, we are, primarily a long-term oriented ALM-based investor, which is different to, what other portfolio managers look at with regards to constraints, time horizon, and so on. I think with regards to attractiveness, given that there's a lot of ambiguity on how strong the US labor market really is, particularly the high yield and CCC credit spreads appear to be vulnerable. That doesn't mean that they need to widen a lot or very quickly, but the air is for sure getting thinner. So that's one thing to consider. Now, again, we are the overwhelming majority of our investments is in investment grade credit, and so we are not really exposed to that. But just to kind of open up the discussion. But I think the other question then is around the longer term outlook. If you do believe that there is that we are facing a somewhat higher inflation environment going forward, then is fixed income the best asset class? I think it's debatable, and I think one needs to think about real assets like private equity, real estate, also private credit, infrastructure, these types of things that can try to insulate you a little bit from the potential purchasing power loss that one might face. And so these are a lot of the considerations that we go through as we construct our strategic asset allocation.
Tapan, do you want to jump in?
Yeah, I agree with Patrick. I mean, sort of the sense that if inflation persists and so on, are bonds really the kind of comfortable resting place? Are yields really allowing for all of those inflation risks? Perhaps to a degree, but I'm still not convinced that that. Yes, I think Alexis is. If we go into a major slowdown, yes, then you'll get the benefit of bonds. But that's a cyclical view. So if you're taking a 2 or 5 year view, I still struggle to see equities and bonds more favorably. But in an inflation persistent story, I would probably still be backing. In that scenario, I would still be backing equities. And on the sector regional stuff, good heavens! I mean, all due respect to portfolio managers, that's frankly, particularly regional stuff, is really hard to get right. I mean, that just it's been such a graveyard for so many people for so long that I just think that particularly if your time horizon isn't that long, you're probably better off just following a momentum strategy rather than trying to kind of time a regional allocation. So I'm not a great believer that that's a place where you should be hanging your kind of your big bets, frankly.
No, fair enough. Alexis, anything to add?
Sure. For a long time I could speak about this, but just if I had to pick one asset class, and if I had a long-term horizon, because on the short term it's very difficult with our election, etc. So on the short term I would be a bit cautious about our election, perhaps other elections. But on a longer term, let's say on 1 or 2 years horizon, there is one asset class that seems very compelling from a valuation point of view, and that would be the European small caps. Because small caps in general in the US and in Europe have not been rewarded at all what they should have delivered. They have not been rewarded by the market. And Europe in general has been slashed or has been forgotten in comparison to the US equity stars, NVIDIA, etc., etc. So if you had to have one audacious proposition, then small caps in Europe would be very compelling on a longer term horizon, I guess. And especially if rates go down, where the interest rates and the burden of debt will be alleviated for those small caps, and they will do a lot of difference. And the positioning is very weak. So every long-term factor aligns on the green light for those kind of equities. But of course, there will be short-term questions.
No, it's very interesting to hear you proactively pitch the idea of small cap. I've heard some pretty compelling presentations from a few fund managers recently about small caps. It does seem that there is growing interest, notwithstanding how they have lagged. And we've done some research ourselves in both Europe as well in the States about the divide that's growing. And it does beg consideration and an examination. So I appreciate you bringing that one up. Let's make sure we talk a little bit about alternatives. And you can pick what element. Clearly, the hot topic these days is private credit, but there's other elements of alternative investing beyond that. One of the questions that came into the chat was, what do you think about alternatives? What's most compelling right now? Who wants to start this one?
Perhaps I can, because I will have a short answer. So I will let you speak after that. We don't invest much in alternatives because we have very liquid portfolios for the end clients. So we cannot have, for example, private credit, etc. So the only one asset class that we can reasonably have, or not, but at the moment we have it, are the metals, and especially the metals used for the energy transition. Because if there is one sure thing for the next, I don't know, for the next 100 years or 50 years is that we have to go through an energy transition that will use a lot of metals. So we buy this kind of assets, even though there is no intrinsic yield, of course, but we believe that the supply will not be sufficient enough. So that could be a good idea on the 5 years horizon, for example.
Yeah. Tapan or Patrick, any thoughts on this?
Oh, well, my thoughts are that really the alternative space is obviously hugely complex and it's just so difficult to generalize, isn't it? But private credit still offers you reasonable looking cash flows. And there is some, I know the term illiquidity premium is much abused, but there is potentially still some illiquidity premium that you can still harvest in private credit, but you have to be mindful of I think the overbought state of the public credit markets. I think they are really significantly overbought because of excess demand from institutional investors. But so you've still got to be mindful of that. But I still think there's a premium there which you can harvest, and you don't have to hang on like private equity for 15 years to be able to get those cash flows, waiting for your returns. The other alternatives I would signal out are ILS, that whole ILS complex. Still, to me, looks like a good diversifier and reasonable sets of returns over the next few years. And potentially, and you've got to be selective, some macro hedge strategies still look to me in this particularly very changeable environment. Macro hedge funds generally, I think, have something to be said for them.
Interesting. Patrick?
Yeah, I mean, alternatives are a focus point of our asset allocation. So as of the end of last year, about 5.5% of our assets under management were invested in alternatives, including private credit and infrastructure, particularly infrastructure that has a lot of beneficial characteristics from an ALM point of view, because you can take longer dated liabilities and replicate them through longer dated assets such as infrastructure. But as Tapan also said, these are all complicated asset classes, and so as I mentioned, we really only invest in investment grade, including on the in the private credit space, and so you need to be very diligent with regards to the external managers that you have, ensuring that they have sufficient expertise. They've been around long enough, and so it's a complex asset class that require quite a bit of time investment to kind of get to know. But I think once you have done the homework, I think it's a compelling asset class also for long-term oriented investors such as insurers.
Very good. I know we're running a little tight on time. There are a handful of questions that have come in, and I do want to touch base on a couple of them. But I want to make sure we spend one little bit of time on a conversation point, and that is what's going on in the US market. Is there a bubble brewing? Is it something you're concerned about? Maybe it's near intermediate term, maybe it's more problematic, but I'll show you one last picture. And this is simple, but the amber line is the S&P 500. The blue line is the equal weight S&P. The bottom line is just simply, the division between the two. And clearly, we know what's transpired with the Magnificent Seven, and that sort of was sexy and cool, but then AI exploded and has taken it on yet another whole leg. Do you see this as a concern, or are we in the midst of a true transformation from the standpoint of potential implications? We already talked about this a little bit, and if you're thinking about AI as an investment theme, are you doing this, or do you think it's right now to be positioned in the AI leaders like NVIDIA, Microsoft, etc., or are you looking more for the sort of industry implementers of AI where you could see beneficiaries in their core businesses? Curious what you think. Anybody want to jump in on this one? bubble and AI.
Yeah, perhaps I can dive in and yeah, we see no bubble on AI. If you look at the valuation, it's even for NVIDIA, etc., it's around 30 times PE, or in EV sales, it's also reasonable. So it's the performance has been very good, but the profits are very high also. So I think there is nothing to compare with in the past, and surely not with the IT bubble in the 2000s, because valuation are reasonable. They are high, but reasonable for the amount of profit growth that's happening for those stocks. So no bubble, but at the same time, the performance potential has been so attractive until now that most of the public and the investors are already positioned. So what would be the marginal investor on this? I don't see many marginal investors on this. That's why we don't see it outperforming for a very long time, until perhaps another wave comes in. But we would more incline toward the broadening thematics of the market, which means that the rest of the S&P could benefit slowly from AI and from also a re-rating compared to the semiconductors industry. So we would not overweight too much without saying that it's a bubble.
Very good. Tapan or Patrick?
Yeah, just a quick one. So I mean, if it is, the history tells us that these things can grow. So my sense is that we're in the early stages of something potentially bigger and brasher. But it's not just AI, of course. Some of these US companies have tremendous market power. So it's a cocktail of outperformance, and that relative divergence could easily grow. So my sense is that if we are in a bubble, we're certainly not in the middle of it, very much in the early stages of it.
No. And Patrick? No, it's not necessarily your ballpark per se.
I mean,
but...
look, bubble or not, I think that's difficult to judge. Again, if we see cracks in the labor market in the US, then I think all bets are off. And I don't think the AI sector can withstand that. Then, it comes back to how quickly can companies bounce back. And I do think that the future is pretty bright for the sector overall. We are looking into data centers and that kind of stuff in terms of sectoral approaches. I think the other thing to remember is that a lot of the concentration has actually been profited from some feedback loops of passive flows. And so concentration in a way begets concentration, because the marginal dollar that flows into, say, the S&P 500 gets allocated to the largest holdings, which currently are, primarily the tech companies. And so I think there's a difference between the underlying earnings and so on, whilst you just have some mechanical flows. But of course, the same applies on the way down, right? And so one just has to be really mindful of that.
Yeah, I think those are all very, very fair comments. And I'd throw out as well that, person within BI that's relevant here is Gina Martin Adams, our US strategist. And she put out a couple of interesting notes over the last few days I would highly recommend reading. One is, what's the comparability of NVIDIA versus Cisco and the current state versus what we saw in the .com, what could be now clearly called a bubble. She looks at it wholly differently. The underlying earnings base is drastically different. It goes back to, Alexis, what you were saying. NVIDIA's multiple has actually come down while the stock has gone up, because the earnings escalation has been huge, and the earnings base of the Magnificent Seven, or the AI group more broadly, is quite large relative to the S&P, where it was very small back in the 1990s. That said, set all of that aside, there are technical indicators that suggest, maybe there's a little bit of a break, but it's not a bubble that's bursting because of AI. It's more like we're seeing a divergence in the median performance versus the index, and we're getting into summer elements that tend to have some whatever influence. And so, yeah, is there a technical pullback? Maybe, but don't call it a bubble that's bursting, because of, what happens with NVIDIA per se. Nonetheless, we're very close to the 3 o'clock mark here in London. I'm cognizant of you all's time as well as that of our audience. There's certainly questions that didn't get answered that we could go through. Maybe there's a way we can follow up in various ways, but I do appreciate the audience popping in questions and sticking with us. I'd remind you that there is the Evenco newsletter that you'll find on the LinkedIn site tomorrow. Take a look at their website for all of those fund forums coming up in autumn. And as I had mentioned, if you've got a terminal, you have Bloomberg Intelligence, please give us a ring, give me a ring. I'd be happy to tell you more about what we do within the context of our investment research business. So anyway, Alex, Patrick, Tapan, thank you very much for your time, for your thoughts, and for sharing your perspectives. And with that, we'll bring this edition to a close. So thank you.
Thank you very much, Tim, and the whole
Hello.
organization. Thank you for the audience for their attention.
Thank you.